The tax year for an individual is the 5th of April each year. So strangely, 6th of April to the 5th of April is what's considered the tax year. For those with companies, the tax year end is relevant, but you've also got to consider the company year end. The tax year end is very important for individuals when planning for their taxes. So there's plenty of things that you've got to consider. So the first one is how much money you've taken out of your business, for example, this year, or how much money you've earned. It could be the difference between whether you've earned your personal allowance, whether you're going to become a higher rate taxpayer, whether you need to make pension contributions, whether you need to make charitable contributions, whether there's anything else tax planning wise you can do. There's so many things you consider. In terms of what I'm asked most about tax year end, it's probably that I'm asked too late. Normally what happens is after the tax year end, I get a phone call. I was having to think about things and I think I've earned quite a lot last year. What can I do to reduce my tax? Because we're already past the tax year end, there's a lot of things that are removed from the equation. There are still a couple of things, but you've limited yourself. Much better if you get in touch with us, we'll speak to an accountant and we can guide you through the options. Pre-year end, I think the best thing to do would be to plan as much as you can the level of income that you've got and pension contributions. I think pension contributions they're probably widely considered one of the most tax efficient things you can do, whether you're an individual or a company. So when a business owner is looking at the level of dividends to take, the best thing to do is to begin by checking that there's available profits. So if there's no available profits to use, okay, then it's irrelevant. You can't take a dividend. Okay. Now, profits for dividend purposes are not looked at in year. Okay, they're looked at on a cumulative basis. So the way I think of it is every year, whatever profits you make go into a big bucket. Every time you take a dividend, it comes out of that bucket, and that bucket basically sits there and builds up year after year after year. If there's no profits, so technical terms retained earnings, if there's no retained earnings in that bucket, then you can't take a dividend. If you haven't made a profit for 10 years, but there's still loads of money in that bucket, then you can take a dividend. That's the first thing to look at. Second thing is then say from a personal level, what dividends are tax efficient? Depending on your scenario, okay, there's lots of different routes you can go down here. The first thing I would do is make sure you've used your dividend allowance, okay? So £500 a year is taxed at a 0% rate. After that, make sure you've used the remainder of your basic rate band. So the basic rate band goes up to £50,270 a year, and out of that will come your salary, any dividends that you've already taken, any other income you've got. Okay, so I can't give you an exact figure on this video because it's personal to you. Once you've used that level, then there's decisions to be made. Okay, so for years that's widely considered the most tax efficient route. It's going up to that £50,270 limit. However, that limit hasn't really changed much over recent years, and as costs are going up for everyone, etc., what you're finding is people are finding it harder and harder to stay in that bracket. So it then comes to the question of what limit do you go to next, and this really is unique to everyone. Okay, so some people are now going up to the £100,000 limit. Some people are looking at their own finances and saying, right, well, I have to do everything possible to stay under that 50,270. Some people are turning around and saying it's irrelevant. You know, I'm now in a position where I cannot live to the 50,270. I need to go to 60,000 a year or 65 because my mortgage costs have gone up by £500 a month. So that's got to come from somewhere. The best thing to do is to actually have a conversation with us about it. It's pointless us planning to a £50,000 limit. At the end of a meeting, you leave and think, well, that's useless because that doesn't even cover my mortgage. Okay, so we've got to make sure we actually have a conversation that's actually bespoke for you. Outside of that, level of dividends I would also consider would be when you're looking at things like mortgages. My view is that if you have a series of tax returns and you go for a mortgage and your income is going up and down, it's harder for the mortgage company. I'm not saying it's impossible, and I'm sure there'll be people that disagree with me on this, okay? But going for a mortgage as a business owner, every time they ask a question, it's like another blocker in the way, okay? So the easier we can make it look for the mortgage company, a nice easy position where you've taken out 50,000 a year for the last 3 years, it's just easier than 80,000, 10,000, 80,000, etc. And it's more tax efficient to do 50 each year than 80, 10, 80, 10. If you're a limited company, again, pension contributions are a very, very tax efficient way of reducing your profits. What you want to look at though is your level of profits for the year and decide that whether a pension contribution is a commercial transaction. So what you want to avoid, but in very simple terms, is that you've got a dormant company, it's sat there with X amount in the bank account, and you think, oh, let's make a nice big pension contribution and make a loss in the year. The problem is the company hasn't done anything, and HMRC can challenge that pension contribution, so it's not allowable for tax. Best thing to do would be to give your accountant a call. We can assess the level of profits that you've actually got in your business. We can even do management accounts, something so we can actually get a very accurate picture if needed. Work out what will actually be a very tax efficient level for you to contribute. There's various allowances for you to consider. Obviously, we can't advise from the financial planning side. So, for example, it may be that we speak to you about the tax side and you speak to your financial advisor to check that the level of pension contributions you're making is at the level that you require for your retirement. But in short, you could be saving 25% tax, for example, on your pension contribution. So you can put £10,000 in per year end and you've knocked off £2,500 off of your corporation tax. And there's an argument to say that the pension therefore only costs you £7,500 to get 10,000 in your pot. When you make a pension contribution from your limited company, it's a business expense. The pension contribution itself is different compared to when you make it personally. So when you make a business contribution at the business directly, okay, it counts as an employer contribution and it goes straight from the company into the pension. If you've made a pension contribution of £10,000, as an example, that £10,000 counts as business expense and you save corporation tax on it. So that could be 19% rate, for example, as a minimum, but it could be a little bit more than that depending on your circumstances. In the pension pot, that £10,000 is the contribution. Okay, so this is where it's slightly different to an individual. So an individual, that pension contribution gets grossed up, so you end up with slightly more. But when you contribute as an individual, you get no corporation tax relief. Instead, if you're a higher rate taxpayer, it can make a difference to your tax because the basic rate band extends by the level of the gross contribution in the pension pot. For those people that are, let's say, a company owner and thinking, well, should I make this as a company contribution or a personal contribution? In the vast majority of cases, the answer is make it out of the company. But again, you can always speak to your financial advisor or us if needed. For those that are self-employed, pension contributions work very different to a limited company. So if you were to make a pension contribution, it does not affect your business profits. Okay? So your business profits are still taxed as normal. However, the pension contribution itself that you make extends your basic rate band. Okay? So what that really means is you're swapping 40% tax for 20%. If you're a basic rate taxpayer, so let's just turn around and say you have profits each year of £35,000 a year, the pension contribution will make no difference to your taxes. Within the pension pot itself, your pension gets grossed up by the government. So if you contribute 8,000, you'll end up with 10,000, for example, in your pension pot. So donating to charity can affect your taxes. Firstly, as a business owner, a charitable contribution can go through the limited company. It therefore counts as a business expense and therefore reduces your corporation tax. If you're an individual and you want to make a charitable contribution, then that's absolutely fine too. What happens, okay, is, I'm sure many of you get there, filling in the form, and there's a box that says gift aid. Okay, so that gift aid effectively asks you to confirm that you're a UK taxpayer and that you actually have a tax bill, essentially. So what happens is you'll tick a box to say you've contributed £50, you want to claim gift aid. The charity actually gets a little bit more in their pot. When we do your personal tax return, what happens is we take the grossed up charitable contribution, okay, and that extends your basic rate band of tax. So instead of it being the 50,270 limit, you add on the charitable contribution amount, therefore swapping some 40% tax for 20% tax. Something to watch out for is, let's say you're a business owner and you've just started your business and you're not taking anything out other than a small salary, for example, and you're earning your personal allowance only. You then go to contribute to charity and you tick that gift aid box. What then happens is we do your personal tax return, and you obviously haven't paid any tax. You end up having a tax bill equivalent to the grossed up, so the amount the actual government grosses up your charitable contribution. Okay, so very weird scenario, and I've had calls in the past where clients turn around and say, how have I got a tax bill when all I've done is I've earned £10,000 and contributed to charity? And that's how. Before the tax year end, to summarise, I think the best thing to do is collate everything, okay, and make sure you understand your position. It's very hard for us to advise if we have a phone call and we ask what level of income you've got and you don't know whether it's £30,000 or £60,000 for the year. The more information you can provide to us, the easier it is for us to advise you. I'd also say don't leave it too late. So giving us a call a couple of days before the end of the tax year doesn't leave enough time for you to actually plan. Give us a call in early March, for example. We can then look at it, and if we turn around and say, yeah, I think the best thing you could do is take an additional dividend, or we decide pension contributions are a tax efficient route, for example, then you've got time to actually put things in place and make those. The last thing we want is you to turn around and say, thanks, that was absolutely amazing advice, but I didn't have enough time to do it because I gave you a call 3 hours before the deadline. Okay, so give us a chance to help you the best we can. Get in touch early and let us know what you want, really. You know, everyone's different, and if it was as simple as everyone being the same, we could just put a standard email together and send it to everyone and do it. But that's not what we're about. We want the bespoke calls with the clients, and you can walk away feeling that you've really gained something from that.